these 22 specific goals that companies have to meet if they want to get money, if they want investment. And of course, if you're a business and you don't have any capital, you don't have a business. So of course they have to do that. But what's happened is, these create perverted incentives. Remember, we talked about Friedman talking about really the socially responsible thing for business is to pursue profit. That should be the incentive. And through that incentive, then they'll have good, good things that they do, like giving money to the local high school. But when you start to change the incentives, then people start optimizing for other incentives. So, for example, like ESG. So if you happen to meet all the factors of a ESG, you get a lot of money. So what do you think happens? Well, companies start trying to optimize for ESG, so they get a lot of money. And how do they do that? Well, they do that through lying and stealing, because of course there is really no way to hit all those goals without that. So they do what we call greenwashing. So they pretend like they're green even though they're not really. How do they do that? Well, so for example, one of the things is to reduce emissions. That's only part of it. So there's environmental, E, environmental, S, social, G is governance. So the E, environmental, is like how much carbon are you outputting, for example, right? Then there's the social. So then that's like, what are you doing socially? And then there's the governance. Do you have a diversified board of people on your government board? But on the environmental side, you need to not produce as much carbon, because supposedly carbon is somehow like the thermometer of the world. That's pretty strange if you think about it. But anyway, they're rated by how much carbon they produce or don't produce. So one of the things that they do is they buy offsets, carbon credits. So for some reason, there's certain things that you can do that create carbon credits. So for example, Tesla, by making electric vehicles, somehow creates carbon credits that can then be sold. And then these companies that produce lots of carbon just buy these carbon credits, and then somehow that gives them a net zero, net being you take the total amount they emit minus what they bought, the credits, gives them a net zero score, right? That's what they're aiming for. The net they're trying to bring down. The problem is that this is all sort of like a big scam. So where are these credits being created from? How are they being traded? And what is that even doing for the economy, for the environment at all? As a matter of fact, emissions have not gone down at all. Businesses now just spend more money to buy offsets. So they haven't changed the amount of carbon going into the world. They've just now created a side market. Now, what's wrong with that? Well, the side market means that for no other reason than to have some arbitrary goal of bringing down carbon, which hasn't done any of that, but now they've created this market, which now companies have to buy into, which makes their expenses go up, which means they have to bring their prices up, which means that you get to pay more for your products and services, which means that your quality of life went down. That means you have to work more hours now to have just the same quality of life that you had before, because costs have gone up so much. That's one example. We can see report after report after report how it's plagued by fraud. A 2021 report by the Carbon Market Watch found that the carbon credit market is plagued by all kinds of fraud. There's double counting, there's wash trading, there's greenwashing, as I said. Greenwashing is when a company makes false or misleading claims about its environmental credentials in order to sell carbon credits. We see large corporations exploiting ESG principles. For instance, some might use shell companies to make their operations appear more ESG compliant than they are. And this isn't just like some theory. We see this over and over and over and over. As a matter of fact, a 2021 report by the Environmental Investigation Agency found that several large corporations were using shell companies to avoid environmental regulations. Saudi Aramco, one of the largest companies in the entire world, has done this with a $28 billion worth of funds. So this is what's happening. When you create a perverse set of incentives, then you get perverse actions. Now, to take advantage of this, of course, the big evil empire, the largest asset manager of the world, BlackRock, has jumped into the mix, and they started creating ESG funds. So now we're going to create these ETFs that have all these ESG companies in there, so we can raise investment capital directly into this ESG fund. But turns out when you invest money, you're trying to get money back. So if I'm investing money, I want it to go to the companies that have the best chance of returning my capital, unless it's a donation. Like I said, invest in things that you want. So I give my money to things that maybe I don't expect the best return from just because that's where I want my money going. But for the most part, if you're investing your money, you're trying to get the best return possible. And it turns out when you run a business based off of their ESG scores, and they're not optimizing for profit, well, turns out they don't have the best profit. So it turns out they don't do very well. And as a matter of fact, BlackRock had to close their ESG fund because of a lack of interest. Why? Because it had poor performance. So you look at all the funds that BlackRock has, and the ones that have the worst performance, you don't want to invest into them. And of course, that's the ESG because they weren't optimizing for profits. And so, there's other parts of it. So then there's the social side, which then kind of led to this DEI, diversity, equity, and inclusion. So it's sort of like virtue signaling. This is what's led to a lot of the Dylan Mulvaney, Budweiser controversy, things like that, because they're trying to now optimize for that, for this DEI, diversity, equity, and inclusion. We can see that a Just Capital report found that 20% of companies with dedicated DEI roles have eliminated or disregarded those roles altogether. So they're adopting it and they're trying to do it, but then they realize it doesn't really work and it's actually hurting their business of being in business, of making profits, and they end up abandoning them. So what they're doing is they're doing some sort of virtue signaling, but really they're not doing anything at all, which is part of the reason why you see Nike running Colin Kaepernick or, like I said, Budweiser with Dylan Mulvaney. They're trying to appease these DEI, gods, these DEI regulators, if you will. But it's a bigger problem than that. So ESG is actually causing, as we started out talking about, an actual crisis. So what do I mean by that? Well, the biggest thing, the E in ESG, is environmental. And supposedly the goal is to bring carbon down. And the number one enemy, according to them, is now energy, specifically fossil fuel energy, which is oil and natural gas. Now, it's funny because do you know what fossil fuel is? Fossil. It comes from fossils. So it makes you think like some bad connotations. Well, fossil fuel, and I'm not a geologist, so if you are, go ahead and leave me comments and tell me if I get this wrong. But fossil fuel comes from fossils, which are actually old plants that are in layers of the earth that have been carbonized and have turned into oil and gas. And so we harvest those out. So it's sort of like environmental, sort of like renewable. But what they've done is they've now labeled those to be bad, and so now we have to go to wind and solar. What they call renewable, which is pretty weird because solar panels and windmills last about 20 years. They're not renewable at all. They're consumable. But anyway, they want to go to these renewables. So like in Germany, for example, because of these ESG metrics, they want to transition their energy into green. So they want to have wind and solar. And so they've started to shut down their energy, including their nuclear reactors. Now, just recently, nuclear reactors are now coming back as being green, but skipping that. What we can see has happened. So we saw the energy prices going through the roof because they shut down their nuclear reactors. Turns out supply and demand still matters. So when they got rid of their nuclear power, their energy prices went through the roof. But then the final straw was the Russia-Ukraine war. They lost the Nord Stream pipelines, and they don't have gas. Now, the reason why this is very, very, very important to understand is because in Europe, you have the southern nations that we call them the pigs: Portugal, Italy, Greece, Spain. All right, the pigs. And they don't really have any industry. They don't have any really economic output, exports. They have tourism mostly. And so they're part of the EU, European Union, but it's Germany that's the manufacturing hub. It's the engine of Europe. They're the ones that produce all the exports, produce all the money, and help support everybody else. But because of what Germany has done by chasing ESG, they've basically shot themselves in the foot, or really shot themselves in the head. And so now, because of energy prices going sky high, it's caused a massive, massive problem.